All right, so every individual has different financial need, hence every investor has a unique investment plan. There are many tools, facilities extended by fund houses to meet the expectation of different type of investors. One such facility is a Systematic Withdrawal Plan or SWP. Let's welcome on board Bharat Phatak, Director, Scripbox, and understand more about a Systematic Withdrawal Plan. Good evening and welcome to the show, Bharat. We are going to talk about Systematic Withdrawal Plans today in depth, but then let's just understand the concept first. What exactly is a Systematic Withdrawal Plan?
Thanks, Kavita, for having me on the show. Systematic Withdrawal Plan. All of us are very familiar with Systematic Investment Plan or SIP. And especially in the last 5-7 years, SIP has become a household word. Everybody knows that you can put small amounts on a monthly basis or even at regular intervals and build up a large corpus over a period of time. And this has been very popular with the Indian investors. This has also become a large force in the market. SWP or Systematic Withdrawal Plan is exactly the mirror image of SIP, which means you put up a lump sum to start with, and over a period of time, you withdraw small amounts to take care of your cash flow needs. So this, in short, is Systematic Withdrawal Plan or SWP.
All right, interesting. Bharat, now let's further divide this particular concept in different on different parameters. Let's try and understand it that way, because although a lot of time we see that SWP is something that senior citizens, or maybe after retirement, if someone wants a regular flow of income, could be something that can be used. But now even for that, there is a certain amount of planning that has to go in your investment process, or at least when you start investing. I want to understand the calculation and the maths that one needs to do before they start investing in order to understand or to figure out how much would they know after a certain period of time. Given the fact that SWP is a kind of a feature that gives you every month, or in whatever intervals you want a regular flow of income, but one should know how much do they want and one should invest accordingly. So what's the maths that works over here?
Okay. So as you very rightly pointed out, there are two stages when one is earning an income and accumulating money, that we call the accumulation stage. And in the retirement stage, you have already built up a large corpus during your working years, and you want to withdraw the money for your expenses. So this is what we call the distribution phase. So SIP is useful for the accumulation phase. SWP is very convenient, very flexible option in your retirement years, or when you are taking money gradually out of your investments which you have built over a long period of time. Now, one very important part is what I get is a cash flow, but it is not necessarily charged to tax as income. And I think this is one of the beauties of the Systematic Withdrawal Plan. I try to keep it in a simple example. If I have invested, let's say, 1 lakh of rupees, and I have invested them in an instrument or in a fund, mutual fund, where the annual expected returns for the next 3, 4, 5 years are about 7%. Now, this is something very similar to a bank deposit. So, good quality debt funds may be able to do something like this. So, if my 1 lakh is going to become 1,07,000 over the next 1 year, can I withdraw about 5,500 rupees every month, so that I will get a cash flow of 5,500 every month, and at the end of the year, I will still have my 1 lakh intact. So, keeping my capital intact, getting a regular cash flow, and distinguish this from income, because in the first month when I withdraw the money, I get 5,500, out of which only 50 rupees may be due to the appreciation or the taxable income, and 5,450 rupees may be coming to me by way of withdrawal of my capital, which will not be taxed in my hands. So in this fashion, if I withdraw this money over the next 1 year, my tax liability will be very, very low, as opposed to a bank deposit. In a bank deposit, what happens is if I put the same 1 lakh in a bank deposit uh, with a view to earn 7,000 rupees as interest, this interest will be taxed every year in my hands. First and foremost, there will be a deduction of tax at source or TDS. And then when I get that income, if I'm crossing the minimum taxable bracket, then I'll be taxed at 10%, 20%, 30%, whatever the rate may be applicable to it. So the systematic withdrawal plan gives me two benefits. It gives me a cash flow, but it gives me an income which is much lower than what I would have be taxed on in case of a bank deposit or a bond
Taxable
or a
amount.
company.
So you mean the taxable amount will be more as compared to an FD income over here?
Taxable amount will be much less. Taxable amount will
Okay.
be much less. So,
Okay.
yeah.
All right. Also, I wanted to understand SWP is offered only by mutual funds. That's the kind of a feature only for investing in mutual fund schemes.
It's offered by only mutual funds, but all types of mutual funds, whether they are equity mutual funds, whether they are debt mutual funds, they are aggressive hybrid funds, they are defensive hybrid funds, or even the balance advantage funds. All type of funds, you can have a systematic withdrawal plan.
Capping or any restriction on the limit of how much can be withdrawn per month?
So there are two limits. One is minimum amount that you must deposit. It is 25,000 rupees, and the minimum amount that you should withdraw is 1,000 rupees. But now some mutual funds have also come out with a facility where you can withdraw 500 rupees and increments of 100 rupees after that. So you can say that I want to withdraw 600, 700, 800 every month. And this can also be created on a monthly or quarterly or yearly basis. There is no compulsion that you must withdraw something on a monthly basis.
You said 25,000 deposit. Now, what is this deposit? What does it mean? Because when you're investing in a mutual fund scheme, it could be an SIP. So every SIP needs to be a 25,000 SIP or a lump sum
So
25,000.
the account balance will have to cross 25,000.
The account balance. Okay, all right.
Right.
So what is actually the protocol in order to avail this particular benefit? You have to fill up a form. What are the technical formalities that you need to do?
You're absolutely right. It's a very simple formality. You have to fill a form and submit it to the registrar or to the mutual fund office. It may take 10-15 days for the SIP to be registered. And your bank account, which is registered at the time of investment, the same bank account can be given for getting the withdrawal money directly into your bank account. So it is not at all a cumbersome process. It's a very simple and straight process.
All right, so I think that will be all about SWP, Systematic Withdrawal Plan, that investors need to note down, and an excellent kind of a feature where you can have a regular flow of income or the way you want money from your investment portfolio. Thank you so much, Bharat, for removing time and helping our viewers with that today. On this note, we'll take a quick break, but then post that, let's figure out how can you accumulate 10 crores in 10 years, and if 10 lakhs is something that you can invest right now after this break. Welcome back. You're watching The Money Show with me, Kavita Thapliyal, and we move on. And before we connect with our other guest of the day today, despite heightened volatility in Indian markets, the confidence of retail investors continues to be strong. Data released by the Association of Mutual Funds for the month of March showed growing investor confidence in the markets. Now, investment via systematic investment plans or SIPs topped rupees 14,000 crore mark for the first time ever. The SIP contribution for March came in at rupees 14,276 crore compared with rupees 13,686 crores in Feb. Similarly, net inflows into open-ended equity jumped 31% to rupees 20,000. 534 crores at a one-year high during March. So that was the AMFI data that's just back, but then that just came on today, and we'll discuss more about this on the show going ahead. But let's talk about accumulating 10 crores in 10 years. The biggest goal of any investment is to grow one's wealth to earn the maximum possible returns. The larger the returns, the better it is for an investor. Now, what if you invest 10 lakhs today and grow it into 10 crores in 10 years? It may sound like a Herculean task, but our next guest, that is Piyush Chandra, Head Mutual Fund Products, IIFL Securities, believes it's possible. Let's welcome him on board and understand what's the maths behind this particular goal. So, hi, good evening, Piyush. And so 10 crores in 10 years, investable amount 10 lakhs if possible. Can we do it?
Good evening, Kavita. Practically, it is impossible to grow 10 lakh rupees investment today and with an investment horizon of 10 years and make it 10 crore. It is practically impossible because if you look at the calculation, even if one does an SIP every month uh, for 10 years at a 12% CAGR return, the SIP amount would be 4,35,000 per month, right? And in next and he has to continue this SIP for next 10 years. And if I look at something like a 10% kind of a average return from the market, the SIP amount for that amount will be 4,85,000. So to say to invest 10 lakh rupees for 10 years and to make it 10 crores is practically impossible.
All right. So now let's keep the target of 10 crores in 10 years. And what's the investable amount? 4 lakh per month. That's what you said.
If I calculate it, in three parameters. One is if I calculated 12% at 12% CAGR return, which is the historical return which Nifty has given. So the investment amount per month is around 4,35,000. If I look at at a 10% kind of a CAGR return for a little conservative client, it will be 4,85,000. But if I'm looking at something with a 8% kind of a CAGR return, wherein the client is actually very conservative, then I'm looking at something like 5,50,000 to be invested every month.
Piyush, let's talk about the investment mix that will be needed to achieve this particular goal. An aggressive equity strategy?
So I would, it would actually depend on the investor and the risk appetite that it has. To discuss this investment strategy or the wealth creation journey, I would like to divide this conversation in three important points. First is strategies that one should look at for building long-term wealth. Second, it should be how one should invest in the market. And third, and most important, something that needs to be avoided or things one shouldn't do in wealth creation journey. So to begin with, first, let's look at strategies that one should have to build long-term creation, long-term wealth. Is firstly, the investor should have a clear investment objective. As in, the case that we're discussing, let's say my investment objective is 10 crores in 10 years. So I should have a very clear investment objective. Obviously, I shouldn't look at short-term returns because they can be volatile. And most importantly, I just shouldn't pull out money, as and when required, because the easiest thing in financial instrument is because they are very liquid. People tend to withdraw money as and when they're required. So, that is a complete no-no. Obviously, starting early and staying invested, helps, and review your portfolios, on a very periodic basis and rebalance the portfolio accordingly. So that, and I think that are the key investment mantras to build long-term wealth.
Quickly, if we want to talk about an equity exposure and within market caps, one should be going heavy in large and mid cap. Obviously, the strategy would change over time, looking at the market condition and the portfolio condition right now at that time, the exposure. What can one start with? What kind of an exposure one can start with? Heavy on large caps?
Obviously, if I am looking out for an aggressive return, I need to be aggressive while investing. So mid caps, stroke small caps, will have a historically mid caps have given better returns as compared to large caps. So my portfolio has to be mid cap heavy. But having said that, it would entirely depend on the risk appetite of the person. My simple submission to every all the investors even when I advise, is buy good businesses now and not stocks or portfolios. Because if you own good businesses over a period of time, when these businesses become big, obviously you know the profitability of the business when it increases, the share price is a long term slaves of the earnings of the company. So obviously your wealth will enhanced or increased over a period of time. And stay invested for long duration, because in longer terms, with 10 years, 15 years, 20 years investment, the compounding works its magic, and that is very, very critical for us to understand. If I can just give you a very small example, if let's say if I have invested 10 lakh rupees today, if with a 15% kind of a CAGR return, my money almost doubles in 4.5 5 years, so 10 becomes 20, and this 20 will become 40 in next in next 4.5 5 years, and that 40 will actually become 80 in next 4.5 5 years. So if I have a horizon of 14 15 years, my 10 lakhs is actually becoming 80 lakhs. And that is the kind of power of compounding magic that we are talking about.
Exactly. So, and that's exactly the roadmap if you want to become a crorepati, and that too in 10 years. Thank you so much, Piyush, for being on the show today and helping our viewers with that. We'll take a quick break, but then post that, we are going to solve your financial portfolio queries with Arnav Pandya. Welcome back. You're watching The Money Show with me, Kavita Thapalial. Now, despite heightened volatility in Indian markets, the confidence of retail investors continues to be strong. Data released by the Association of Mutual Funds for the month of March showed growing investor confidence in the markets via investments through SIPs. Now, talking about the numbers, SIP topped to rupees almost 14,000 crore for the first time ever. The SIP contribution for March came in at 14,276 as compared to 13,686 in Feb. Similarly, net inflows into open-ended equity funds jumped 31% to rupees 20,534 crore to a one-year high during March. So, let's analyze all of this. We have with us Arnav Pandya, founder Money Edu School. Arnav, good evening, and we'll be taking our viewer queries ahead. But then before that, let's just look at the AMFI numbers. And do you think the investor confidence is still intact, or there is some kind of a sluggishness now that we can see in the numbers? Although the SIP numbers have been an all-time high, but then what kind of these SIP contributions are, and what does it mean?
Kavita. So I do not think that there has been any let up as far as the investor interest into investing into equities through the mutual fund route is concerned. Because if you look at numbers from all perspectives, one, the SIP book is not only steady, but it is steadily rising. So that trend continues, which means that even though you will be finding that a large number of old SIP are being stopped, an increasing number are also being started. So, which is pushing up the amount which is coming into the mutual fund kitty through the SIP route. So, that is one single thing. So, whenever we look at this data, I think we need to look at it in the proper perspective on an overall basis, because just picking one item out of the entire set might not give the correct picture. So, as far as investor interest into equity funds are concerned, the March data shows very clearly that that is robust, and also the fact that March, from the data, since the net inflows into equity funds is 20,000 crores, it looks as if very clearly that because of some element of stability, at least as far as investors thinking is concerned, they have not pulled out large amounts from equities, or rather from equity oriented mutual funds. On the other hand, if you look at the data on the debt side, there, I mean, you will find that there is a large pull out from liquid funds, which is normal, because that is because most companies and other entities pull out money to pay their final advance tax payments, which comes into on 15th of March. And at the end of March, we saw that last 7-8 day time period when there was a frenzy for investors to lock themselves into various kinds of longer term debt mutual funds, since from 1st April the new taxation norms for debt funds would kick in. So at least on an overall basis, retail investors have reimposed their faith as far as mutual funds are concerned.
A quick question, and then we'll go to our viewer who's online with us and waiting to ask his question. But then, which category within equity mutual funds have seen maximum inflow?
So if you look at, there are various categories. For example, see, after a long period of time, you also find that large cap funds are seeing a good amount of inflow. So that is nearly 1,000 crores has come into large cap. The mid cap, the small cap, the flexi cap category are the ones which are consistently seeing inflows, which remain high. So this is the positive thing, that even in this kind of volatile situation, we find that investors are sticking to their plan, which is of investing across a basket of mutual funds or equity oriented mutual funds across various market caps. And you can see virtually nearly all of these categories have seen a consistent amount of inflow coming in from investors.
All right, so that's all about the AMFI data. But then we move on, and we also have our first viewer online with us, Paresh from Bangalore. But then before I connect with him, if you're watching our show and if you want to ask us any question, you can send us your query on our WhatsApp number, which is 865-797-4571. You can also email us your query on themoneyshow@etnow.tv. So let's talk to Paresh. Hi, Paresh. Good evening. Thank you so much for sending us your query. How are you doing today?
I'm doing well. Good evening.
All right. So the details given by you, you are investing in a ICICI Pru's multi-asset fund of fund? Or you want to
Yes.
invest in a multi-asset fund?
I want to invest in multi-asset fund, but I have a query on what would be the better option, a passive fund of funds or an actively managed multi-asset fund? Because ICICI offers both of them, so I'm getting confused on which one to choose.
Why specific interest in this category, may I ask?
Yes. So till now, I don't have any exposure to commodities, be gold or any commodity. And given the volatility in market, I was looking for the new SIP that I'm thinking to start to have something more stable fund. I mean, better than conservative hybrid, but not pure play equity.
And it is not specifically because of the exposure in equity commodity that you're looking at a multi-asset fund?
Yes.
All right. Interesting. So, Arnav, first of all, the category on its own, multi-asset, has been doing well. Earlier, we saw a lot of interest in balance advantage, but then now all of a sudden, because so much of thrust has been given on diversification, multi-asset as a category is picking up. But within that also, what kind of investors should actually be diversifying themselves in this category? Because if you already are well diversified across market caps, and yes, commodity exposure is a benefit, is an advantage over here for diversification. But even then, does one really need to have a multi-asset fund?
So first, let us just look at the difference between a normal, say something like a dynamic asset allocation fund and a multi-asset fund. So normally when you have a kind of asset allocation fund, which is a dynamic in nature, then the choice for the fund manager is usually between debt, equity, and cash being the third option. So the fund manager there moves between debt and equity depending on their market outlook as well as the parameters that they use. The moment we come to a multi-asset fund, now one thing is that in a multi-asset fund there are more than two asset classes which are to be there in the portfolio. So this becomes equity, debt, and on most occasions gold, because that is the third asset where you have an opportunity to invest. Many funds also have real estate or alternative investments where they allocate a very small amount, but that is not very significant from the statistical point of view in terms of the overall portfolio. So a multi-asset fund ultimately comes down to debt, equity, and gold. Now the question is that if you in your portfolio already have these three assets classes, maybe you have a gold fund or you have a sovereign gold bond, and you also have some debt investments, you also have equity investments, then a multi-asset fund is not required for you because you're already doing some kind of asset allocation mix. However, if you do not have this kind of mixture in your portfolio, you have only say one type of fund and you want to diversify across these multi-assets through a single investment, then a multi-asset fund becomes suitable for you, because there the fund manager will make the changes and do the exact allocation. But again, what will happen is that if you just want, say, an exposure to gold, a multi-asset fund will give you a very small exposure, because even a multi-asset fund by itself is a small part of your portfolio. Within that, gold is a very small part, so it might not achieve your needs. Now, coming to the question which the investor has said, that there are two types of multi-asset fund. One is an active fund, where the fund manager selects each security within the portfolio and the allocation to it. This is an actively managed fund, which is like a normal mutual fund which is being managed. And as compared to this, there is also a passive fund of fund. Now, two things are to be noted here. One, it is a fund of fund, which means that this fund invests in other mutual fund schemes. It need not necessarily be from the same fund house. So if you see ICICI's fund of funds, it has schemes from various other fund houses also. Second is that this is a passive scheme, which means that these funds which are selected by this FOF are passive in nature. So there is no active element involved here. So one, the fund of fund by itself, since it invests into another fund and these are multiple funds, the expense ratio which you normally get, the benefit which you get in terms of a passive fund where it's very low, actually reduces to a certain extent. And as compared to an active fund, my choice would be that you should go in for an active multi-asset fund if you are choosing this for your portfolio, because at least you have a very clear outlook of where the investment is going, what is the kind of securities that are being held. Because going one step below, looking at the funds which are held by the fund of funds, then seeing which securities they have, what is the allocation, that becomes very difficult for an investor. So it's better to go in for an actively managed multi-asset fund if it's required for the portfolio.
Thank you so much, Paresh, for sending us your query. We move on. Naveen from Andhra Pradesh wants to ask his question. Hi, Naveen. How are you doing?
Yeah, I'm doing good. Thank you. So thank you for picking my question as well.
All right. So you have ICICI Pro Nifty 50 Index, UTI Next 50 Index, Bharat Phatak Flexi Cap, PGIM Mid Cap, and Axis Small Cap, right? And you will invest for next 14.
This is my portfolio.
Right.
Yeah. So I want to invest for next 14 years. So I want to just review my portfolio. So how healthy it is, or should I change something in this?
All right. Do you have a financial planner on board? Your consulting one?
Yeah, I want to, my goal is to build wealth, that's it. So after 14 years, I need at least 1 crore or 2 crore rupees.
At least
so
one
I
or
can
two?
Increase my, yeah, I can increase my SIPs every year at 10 to 15, 20%.
How much are you investing in Axis Small Cap?
It's 3,000.
All right. Okay, so currently 14,000. How much can you increase your SIP amount?
I can increase by 20% every year.
20% every year. Okay. Another 1 or 2 crores after 14 years with the current portfolio. Possible.
So let us look at it in various aspects. One is that time horizon is 14 years, which is a very long period of time. So the approach that needs to be adopted can be an equity heavy approach, and which the investor has already done. So in that sense, this is the way to go about the process. Second is that let us look at the portfolio in terms of the kind of exposure there is. So there is a Nifty 50 fund, which means that the top 50 stocks, there is a fund with the next top 50 stocks, which means that if you take these two together, it becomes like virtually the entire top 100 stocks, which comprises the entire large cap space that is there. There is a flexi cap fund where in the Parakparik flexi cap fund, there's a value oriented approach. It's a slightly large cap heavy portfolio. There is also an international exposure in this portfolio, though this has been reducing due to the limits which has been set by the market regulator. Plus, there is a mid cap fund, there is a small cap fund. So if you look at the overall portfolio in terms of the weightages, it is slightly large cap heavy, which is what it is supposed to be, with a flavor of mid and small caps, which is there. The third thing is that in terms of the nature of the funds, most of these are good funds. They have been well performing funds. My only concern would be with respect to the small cap fund, where if the investor wants to, he can change the Axis small cap fund to something like a Nippon small cap fund. And that will have a better balance within the portfolio. In terms of the amount which is already being invested and which the investor is going to increase or he can increase, these idea should be that every year there should be an increase in the amount which is invested. For the moment, stick to the 5 funds which are already there. And if you continue on this way, then I don't think there should be a problem as far as the achievement of the goal is concerned. Always try and see if you can have a higher corpus. Do not stop just because you think that you are going to achieve your target. Try and have a higher corpus because it can be used for some other goal also.
All right, Naveen, that's the answer for you. Anything else you want to ask?
No, nothing. I'm good. Thank you so much.
All the best. On that note, we'll take a quick break and post that viewer queries continue.